straight to Markus Helsing from AlphaBroking. He is live at our Melbourne studio for you. Markus, a warm welcome into the show. Looking at that support in on the iron ore plays today, it's, I suppose, a blessed counterpoint to the crude story that looks to be one-way traffic for now. What are you seeing as the drivers next 6 months that are going to prove supportive of this level of around 85 plus a tonne for the iron ore price?
I think, hi, thanks for having me on the show. Look, I think the key driver really, especially the next 6 months, will be the US dollar, in our view. I mean, we had an 8-year bull run, and now we have sort of a classical post-Federal Reserve, sort of a buy the rumor, sell the fact scenario. So the whole reaction in the markets, particularly in the currency market, has been a confirming market, basically confirming a US dollar topping scenario. And that, in essence, is an enormous underlying support for commodities. Well, what I see iron ore specific is the backwardation is stubbornly at $18 to $20 1 year out. In other words, forward prices are still trading at an $18 to $20 discount to the spot price, currently around $86 a tonne. So, look, to us, really, this is clearly a sign that the market has not changed, that the supply is there. It's really purely China dependent, as we all know. The benefit of a weaker US dollar from here cannot be underrated, and we reckon that might just be responsible to hold this show and keep this Goldilocks scenario for a lot longer than otherwise. Yeah, realistically, you know, what more was the market minded to believe would happen? That suddenly Janet Yellen would embrace the euphoria around, I suppose, speculation rather than substance on fiscal policy, and that we would be off to the races with 4+ hikes? I mean, who was actually promulgating that idea in the first place? They need their head read, Markus. Well, I'm not that sure yet about that. I mean, there's a lot of unknowns out there, as we all know. Look, I reckon these 4 rate hikes could still be on the agenda. Who knows? I mean, really, with the Trump factor, we have an unknown that's beyond belief. Look, I really reckon, just sticking to the actual numbers in front of us, to us, this US dollar looks really the dominant force. China is chipping away nicely. And I think the one thing about iron ore and China that we have to keep in mind, they don't have their major meeting, 5-year meeting, up till October. And you tend to see in China years like that, they hold up the show for as long as possible. So I think that's another contributing factor that will most likely help iron ore prices. What do we think of the one dissent, Markus? I mean, everyone's going along with the herd story today, and that was the majority vote. But there was one dissenter emanating from Minneapolis. Now, there was a telling line: doing better than your parents is far harder now than it has been in earlier generations. You look at the haves and the have-nots that will basically, on the fringes, by definition, be worse off as these rates go up. This is the trade-off, is it not, between an outbreak of inflation and preventing that, and perhaps leaving marginalised some on the peripheral. Well, I think that's one for politicians and philosophers, I think. But look, I think you're hitting here some very deep territory. But look, really, what is clear is that the Federal Reserve needs more room for the next downturn. They need to get rates up to 2–2.5% as a matter of urgency, so they've got to be more room to work with when we actually have some real issues. And I think the inflation factor, to me, they're very lucky, because really it's all about wages, and they are held down, and that's basically explaining why you have so many working poor in the US. They're getting paid bugger all, and that's an ongoing problem. So I think that's one for the politicians to solve, but the markets can't do it, neither can the Federal Reserve. Let's move into the energy markets. Who can do anything to arrest some of the downward pressure now that's coming into play? The shale industry is basically girded its loins and risen phoenix-like from Lazarus-like status, is it not? You know, some time ago. What do we make of this? It's really a game changer. The Permian Basin, the untapped potential there, it's all within grasp for shale. Why would we get upside on the basis of that? Look, I think the overall pictures the OPEC report has shown is obviously the overall inventories are still just a huge drag on the whole show. Look, in a moment, I think energy is the main game to watch. For investors, in my opinion, they should watch energy stocks like a hawk because we expect some major lows over the next few months.
Wow.
Oil in the moment around $48, $80, $49 a barrel, West Texas. We would like to see it a bit lower. I think that's possible. However, a weaker US dollar might just make sure that these lows might not be in the low 40s, might be more in the mid to even high 40s before we start to bounce. But I mean, oil stocks, you look at the Santos's, your geared stocks, there's a lot of them in the US just like that.
Yeah.
I mean, at some point, they in our view, offer an enormous potential because, I mean, as you just mentioned, I mean, we're still in a very oil-dependent world economy. So we still expect the next big move will be to the upside in oil.
That's interesting. So the likes of Russia that did sign on for the détente in production, are you believing that they do anything other than go back to their bad old ways when it runs out, which is very, very, very soon?
I think the Russians are another unknown. I mean, they're beyond the Trump unknown. I mean, essentially, the bottom line is the Russians, their main income is from energy exports. Let's not forget that. And they're now actually the biggest energy exporter in the world. And so look, really, the dependence and also the interdependency between Europe and Russia is quite strong. So I think generally what Russia will do, I think they will try to obviously have an interest to keep oil prices stable and ultimately to see them actually improve in price. So I think they'll play with it as much as they can and will. How compliant they are, I mean, that's really, I mean, who is going to check what's happening deep Siberia on the old oil well? I mean, it's really a bit out there. But generally in the moment, what I'm reading, what I'm hearing, and what I'm basically seeing from reports from Europe, that actually is the case. They're trying to stick to it. So let's see till we prove it otherwise.
The moves that we've seen into the Australian dollar and the positioning of, as you were just flagging before, the energy sector here, how are they going to circumnavigate this support on the local unit? Because, of course, their production costs, relatively speaking to shale, still look pretty high, do they not?
Well, they do. And I think it won't be helped. Well, the Aussie dollar essentially will go higher as it turns out, so at least some of their import costs will fall on the back of that, which is substantial. I really reckon Australia is a bit of a sideshow on the global scale, but obviously when you look that we're now becoming one of the biggest, if not the biggest, liquid natural gas exporters, we probably, look, let me say it differently, I think the major input cost has been actioned, and I just don't think there's going to be a huge benefit of a higher Aussie dollar for the input cost side of things. However, on the export front, we might actually have a bit of a drag on a higher Aussie dollar. We still think the Aussie dollar will see 85 cents by mid to late this year.
And Marcus, any views on the Shell sell down in its Woodside stake? When might be an opportune time for it to exercise that right? It's already made a move on some of its peripheral assets globally, the likes of tar sands out of Canada. Do we see Woodside as very much near the top of its to-do list on a sell-down, or that's for another month, another year?
I think what's going to be said about Woodside, the price action with all that's happened over the last few years has been enormously stable. It's been a very, if you like, a boring stock to look at in price action. But if you look at the details, I think they actually very well positioned from here onwards. So for us, Woodside as a company investor should have in a portfolio as a must-have. You know, essentially, they could be quite ready to benefit down the track. While being relatively boring, it could be exciting when oil is starting to move north. But I think really for us, the likes of Santos and this type of plays are a lot more exciting. They've got a bit more gearing attached to it, so hence you take more heat when things go lower. However, we do think something like Santos has a lot more potential on the north side.
Broadly speaking on this market, today the news that's basically sort of a bit of a nail in the coffin for capital lost in Q1 of 2017. You've got Alinta that only adds to the Western Power and the Accolades wine scrapping of an IPO thematic on the markets. So when you have that absence of deal flow, what do you say the market looks like sort of heading into H2 now, or Q2?
That's a very, very good point. I mean, really, when you look at the market today, what's holding up the market is bouncing resource stocks, you know. I think probably the one thing for our market, you've got to just look a bit on a different sector. The banking sector, to me, could have a bit of a revival if it might only be short, medium term. Our banks are still relatively well priced, really, if you look at their peers in the US, particularly in Europe, let alone Japan. But I mean, this sort of lower regulation type approach from the Trump administration, I think, will have a positive impact on the banking sector. So I think if anyone is bullish on the broader index, we believe probably the banking sector will be the one that might do a bit more of the lifting in the second quarter.
They're all going, of course, for the same slice of a static pie, relatively speaking, given that they've effectively hoist the white flag over growth options beyond Australia. NAB's moved to raise its variable and investor home loan rates. Basically, are you surprised by that, or you think that was an inevitability following what CBA's been doing? And who comes next?
I think the writing is on the wall. I mean, if you see what the Reserve Bank comes out with, I mean, something's got to be done, and I think they're acting preemptively, so to avoid any too drastic actions from the regulators. But as you say, I mean, the pie is that big, and that's about it. And I mean, we have an enormous amount of debt load in Australia. I think on the very big picture, over the next 12 to 18 months, I do see trouble coming, but not at this point in time. I just think banks with current dividends as it is, are still a hold. It's not something that I'm getting excited about. As a matter of fact, on a macro picture, I think that is a worrying factor, our debt, and hence the banks down the track, but not yet.
I guess you'd say the same thing on Telstra.
Well, Telstra is a great park, you know. I mean, if you look at telecom companies all around the world, they've been privatized the last 20 years, but they actually held on to about 60-70% of their workforce pre-privatization. So you have sort of a public philosophy in a private industry, private managed or privately floated company. I think that the problem we've seen now over the last few years is basically an efficiency issue, productivity issue, and so on and so on. I think Telstra, after this correction to us, is a good park. It's a great yield. We think from here onwards, Telstra, again, should be a part of a portfolio. Don't get too excited about it. But yield-wise, if you look at the yield, even if dividends come off over years, from here onwards, especially for the next 2.5 years, is a good hold.
Yeah, I was going to say 2019, maybe reassess actively that position. Markus, thank you so much. Appreciate it. Markus Helsing,